The dollar is dead. The dollar is finished. It's never coming back. Well, not exactly. In today's video, I am going to show you what's actually happening with the US dollar. My name is David Quintieri. I spend the hours a day researching, so you don't have to. All you got to do is subscribe. I bring the latest and greatest. First thing I'm going to show you is what's going on with the debt ceiling, something that is actually going to see a lot more money being put into it. And the next is a whole series of charts giving you updates on what's happening with the US dollar. Let's begin right away, no time to waste. I thought this was interesting just to show you to begin, and that is essentially that we are definitely not seeing the recession that everybody else is talking about coming in 2023. So with those kind of big bets being pulled off, the rates are creeping higher at this point. Not permanently baked into the cake, but if we can creep up to 60 or 70% odds of a hike, we're probably going to go that way in June. And what he's talking about here is basically that the odds of another Federal Reserve increase in the interest rates is not likely at this point. However, that could continue, the momentum could build, and then in just basically a very short period of time, we could see another rate hike that would put downward pressure once again on everything. However, you look at the US equities, US stocks, they're performing very well. Now, of course, there's this inverse relationship between the stock market and the dollar. And right now, we're seeing a lot of these stocks doing very well. Can anybody say Nvidia? Whole different circumstance there, but the speculation is clearly on the table. Money, US dollars, have left one thing and they've gone into another. I'll show you some of that. You got to stick with me though as we move into this part. I'm showing you specifically where the money is going to go, guaranteed. And we are talking about what's happening with the debt ceiling at the time of this recording. It is very important just to show us what's been going on with the debt ceiling. They're struggling. Oh my goodness, are we going to get a deal done? This and that. Well, the deal, which is not final, is at the time of this recording, would increase funding for discretionary spending on military. That's right. Guess who wins in all of this? The military industrial complex. See, billions upon billions are going to go into this more than they did last year. Billions more will be funneled in. And I believe it's important more than ever before to understand where your money is being spent. That's a topic for a different day. Let me show you this now. If you can see for yourself, Kaplan, who, from the Fed, Kaplan is somebody that, I think is really well versed on the subject to be talking about this. And it happens to be at a point at which the crisis has been really brewing. He's talking about the bank crisis, talking about the debt ceiling, and in this case here, he said something that you must know. Okay. Monetary policy is not the cause of this debt buildup, but it has certainly enabled it. The Fed now owns more than $8 trillion of treasury bonds and mortgage-backed securities and working to run off its balance sheet at a rate of $95 billion per month. Just recently in the last week, I think they got rid of something ridiculously small, like 4 billion or something. So it's going to be hard to get to the levels that they suggest they will. But did you see what he said? They enabled it. And they absolutely did. By keeping interest rates super low for super long, they created a monster. And they know that they can't get rid of it. And that's why we see all of the issues popping up today with these bank crises. You don't think it's connected? Of course it is. It is absolutely critical to that. But let me show you the charts. That's what you came here for, right? Let me get into it right here. First one. We don't want your dollars. This is a chart from Bloomberg, and they're highlighting specifically the total global FX foreign exchange reserves. Okay, now that's an inverse chart. So the higher it goes, the lower it is. And it's just showing us something very interesting that at this point, global reserves are declining. Dollar weakness has not so far sparked reserve demand. But it's interesting as we get into it. Let me show you a few things. Dollar-denominated credit to emerging markets falling at a rising pace. I think ultimately a lot of these, and as they say here, the largest decline excluding the global financial crisis. What we're seeing in a lot of these countries is either they don't want to deal with the US for one reason or another, or they literally can't because of sanctions, because they're partnered with a country that is sanctioned. So that's what's happening right now. BRICS nations and so on, you know the deal. Look at this one. Commodity demand lackluster despite dollar weakness. What does that signal? Of course, this could be the result of a slowdown, less demand perhaps coming from China. They're not buying as much of those commodities, less demand overall. And so you see that showing up in the charts. Dollar sell-off has more to go, measured in different ways. This is just giving us on that golden line there, the US real yield curve. And for a lot of people, they can see this as a very good indicator. Why? It's because like almost 100% of the time, whenever we have a yield curve inversion, that is the trigger. And as soon as it flips the other way, soon after a recession follows. That's what's happening right here, right now. I think everybody should be paying attention. Now, the recession, as they mention it, doesn't have to affect stocks. Doesn't have to be that case. In fact, they could just print a whole bunch of money. They could drop interest rates and actually juice up risk assets. You might see something like a Bitcoin double in a very short period of time because we go risk on. Bitcoin has held up better than most people have ever anticipated. There was a lot of suggestion that it would fall down to that 12,000, maybe even below 10,000. I think maybe 16,000 was the bottom in this part of the cycle. So it's done much better than most people would have expected it to. That is definitely a risk asset. And what's happening here? Number one, people are losing faith in the US dollar, but at the same time, they want diversification out of these other things where they may have been putting their cash before. Okay, that's part of it, right? And they're using it as a temporary hold. Also, they don't trust things like Tether and other so-called stablecoins because of all the chaos that's been going on with that. Money markets have definitely been the winner, let me tell you, okay? Because this is the money market funds. You could see month after month after month, a lot of cash has been pouring in, and we compare those money market assets to what's happening with the banks. The banks' liabilities or, let's say deposits, that's the red line in an inverse, okay? They're just trying to show you that these are mirrored. And as the money's been leaving the banks, it's been going into the money market funds. It's kind of in a way just like liquid available cash. That's the way that investors see it. So you can take what you want from that, but I think there is a big concern over what's happening with the bank crisis, not resolved at all. Two charts to show you here. Let me get to this. One is the Fed balance sheet. Well, after spiking quite a bit here during the bank crisis, that has, still been coming down. They're weaning off of their treasuries. They're weaning off the mortgage-backed securities. You're seeing that in the charts right there, balance sheets. At the same time, this is the U.S. pending home sales. That's the blue, as well as the 30-year fixed mortgage. That's an inverse. And mortgages at, by the way, over 7% right now, which it did hit there before, came down under 6, I believe it was, and then, shot back up. So it's been certainly, up and down, but at this time, we're just watching this whole cycle come through. And when you have mortgage rates that are too high, unsustainably high for this type of environment, it puts a lot of downward pressure. Who is the weakest link? Where should you keep your money out of right now? If it was me, I'd be keeping my money out of commercial real estate. You do what you want with your money. That's certainly a gamble, but look at commercial real estate, retail, as well as, There are some, like the commercial real estate side, multifamily could be good. You look at, Amazon in this case here, you look at that sort of side, the warehousing, that could be good. Industrial could also be good, depends, that's iffy. But when I'm looking at office, when I'm looking at retail, oh my goodness, I wouldn't want to touch that. So if you are invested in REITs, real estate investment trusts, maybe it's directly, or maybe that's a mutual fund, be very careful where they've got their money into. Just a REIT is very general, okay? So watch that. Take a look at that. Maybe you've got an ETF. Maybe you've got something that's broadly, broadly investing. Be careful. Look at the details. Do you have a money manager, a financial analyst, or manager that's taking care of your cash? Ask them this question. Are these exposed to real estate investment trusts? Are these exposed to office or to retail real estate in any way? Or maybe they're a company that somehow deals directly with the commercial real estate. What about in the scenario of SVB? All these different things. You got to do that due diligence on your own. But certainly if you've got somebody managing your money, you got to ask these questions. These are the questions to ask. I hope that this information was informative to you. I'll try to bring you the latest and greatest. What I ask is that you share this video with somebody that you know. Put it on your Facebook, put it on your Twitter. I'm on there every single day. We can talk on there, exchange information. I'll see you on the next one. Hit that thumbs up, all right? And I'll see you tomorrow. Take care.